Welcome back to the Economics of Real Estate. I'm Dylan Silbernagel. That's my partner, Matthew Gizzie. This is the show where we break down what's going on currently in the GTA housing market. We do it at the start of every month. Matt, how are you doing today, brother?
I'm good, buddy. It's a beautiful day out. Got a little heat out there before it gets a little too cold, so we'll take that, I guess.
Yeah, no doubt, no doubt. I think it's time to get some of those last warm days in, maybe on the golf course. And then, like you and I said, it's going to be sim season. So we'll be enjoying that personally. But, anyways,
Yep.
Matt, today's focus, as we said, we're going to do our usual deep dive into the different neighborhoods and communities that we cover. But first, we wanted to start with a very high level conversation of where the market is currently. We're going to be taking a look at median sale price. We're going to be taking a look at active listings. And really, we're going to be focusing on York for this first part. And the main reason for this, Matt, is there's been a lot of speculation around like, okay, are these interest rate cuts going to be the thing that move the needle and make a difference and start to turn the housing market around a little bit? And really, again, just reflecting on where we are currently in 25, maybe in comparison to where we thought we'd be, where we could have been, and most importantly, taking a look at some of the signs on where we might be headed. So that's what we're going to dive into today. And Matt, I know we have another video coming up later this week because you went on a deep dive last night. So we look forward to that. We'll be posting that on Thursday at some point. Anything you want to share there before we jump into it?
Yeah, I think there's a lot of headwinds in kind of the economy and in the market right now, and it's definitely a time to be very strategic and do your due diligence. I think with some of the charts we're going to show today and also on Thursday, it's going to show people that even though we're getting these rate cuts right now, they take time to get through the market. And there's just so many headwinds, whether you're looking at the jobs market, whether you're looking at investment in Canada as a whole. There's a lot of headwinds going on, the tariffs and the trade war with the US. A lot of things to keep an eye on that could definitely shape the next 12 months of the real estate market.
Yeah, so let's jump right into it. And Matt, I think one of the important things that we're going to start to show today as we've started to have these interest rate cuts is the Bank of Canada has also come out and said, like, our cuts are no longer changing the economy. It's not what's going to turn this thing around. And so we'll talk further about what that means in terms of outlook for that. But I think what it's going to show is none of these cuts have really moved the needle at all in terms of where our market is currently.
Yeah.
Let's jump in and take a quick look at York region as our starting point. So taking a look here at active listings, this is now York region across all home types dating back to the start of 2020. And you can just see our levels of inventory kind of continue to keep growing here. Like every time we bottom out, we end up hitting a new high for what our bottoms are. Our peaks end up hitting new peaks. And this is the trend line that we're on currently. And one of the main reasons for this is buyers just haven't been in the market. Our sales volume, particularly in 2025, because this is, I guess, the great thing I want to show here, Matt, is this isn't uniquely a 2025 problem. I think it's escalated in 2025. As you can see, our inventory levels dramatically shoot up. But this has been a trend line we've really been on since the rates started increasing there in 2022.
Yeah, exactly. You can see the two lines, kind of the upper bound and the lower bound, and we keep making higher highs um, in new listings, and at the end of the year, they're only dropping down to a certain level, which is higher than the previous year, which means so much is still sitting on the market. And I think even though interest rates are dropping here, there's a lot of people who aren't really need to move off of these properties. We had a lot of investment in the real estate market. We had a lot of exuberance in the real estate market. We had a lot of people refinancing properties when interest rates were so low. And now, because of how extended interest rates got, not everyone can afford the property that they got into, the property that they refinanced. So we're seeing more and more of these properties hit the market. And, we can see in 2025 where we peaked in active listings, we rolled down a little bit, but we've come back up to finish off the year with a strong active listings, where kind of in the past we've seen a peak and then we've seen just a drop down as the rest of the year plays out. So Definitely interesting, keeping an eye on to see how much extension we get November and December with the active listings, how many roll off. Because it'll be interesting to see going into next year if you don't get a lot of these to roll over. Um, you know, the start of the year might start sooner than later because all the properties are already on the market. Nobody kind of rolled them off too much. So definitely something to keep an eye on.
Yeah, I think it's interesting to note as you take a look at where we kind of bottom out there in December, right before the start of the new year, we start to see those drops in terms of our active listing levels. Now, we've seen a couple of like other peaks coming up here. We've shot up throughout the year. It's interesting to see one first. This is higher than what we'd like it to be currently, but will it actually come down? Because at the moment, it's still lingering fairly high in terms of the active listings. So are people going to just leave their homes on the market? We've seen homes kind of cancel and relist and just ride it out, find a price that they're acceptable with, and try to hold out at that price point. I don't know, Matt. It's going to be interesting to see what this active listing level drops off to in the month of December when we compare it to our historic numbers for the last 4 years or so. Okay, taking a look at median price again, noting from the high that we saw there in March of 2022, it's interesting to see that really if I come into 2025, this is where we started the year and we were okay there a little bit. We kind of had that non-eventful spring is what it felt like, but what really happened was our fall market hasn't arrived. We're now in the month of November. We've got our two strongest months behind us should be for the fall, our September and October. And now, while we did see a little bit of an uptick in York Region for median price, we've still trended downwards in terms of that pricing throughout all of 2025. And really, Matt, we were poised at the end of last year to have this thing turn around a little bit, and it just didn't seem to quite get there. And I think the other thing to acknowledge is just that what we did see in the spring of 2024, where for a while there we even had multiple offers coming back. So this section of the chart in particular is a little disheartening to see because we haven't hit that kind of leveling out, that bottom that we thought we might have hit at the end of last year.
Yeah, so we've got a bit of a trend line on the way down. We bounced off it last month or in September. We saw a little acceleration in October. We've seen some late years acceleration in some of the years prior as well. So to kind of be expected for the October.
Mm-hmm.
So it'll be interesting to see November, December. Do we break below this line that we've bounced off twice now? And that'll definitely add some pressure going into next year as to how much higher prices can come. I think we're going to still be in a downwards trend on this chart. But I think really what's important here is what does November, December do? Do we break below this line? If so, there's going to be some pain to come the new year, I think.
Yeah, I agree. For this moment, we're still seeing that we're above where we were back in 2020, which is a great sign. With the lowest months on this chart being that January 2020, April 2020, and May 2020, and then obviously, really since May is when the housing market really started picking up again. After we'd kind of been in COVID for a couple of months, we've been locked down a couple of months, and then it just started moving. And obviously, our highs there being in the 2022 numbers, being February, January, and March. Those first 3 months being the highs that we saw in the last 5 years, as that was the peak of the market. All right, talking about sales volume, Matt, this is the one that's just been a struggle to kind of come to terms with this year, as we've really seen buyers not taking advantage of the lower interest rates and the lower prices, because last year in 2024, prices were definitely higher, interest rates were higher, but we sold more homes last year than we have so far in 2025. So it's interesting to take note of that. And then, of course, talk to me a little bit about our trend lines and our marks that you lined down for everybody here today.
Yeah, so on the left there, that blue box with the red line going up. This was during a rate cut period, except for in 2014 where you can see the line dip below the red line. we had interest rates come up during that time, and the bond market had moved up during that time. So we got a little bit less on the transaction volume, but we can see that in a very bullish market from 2011 up until when we peaked out 2017. um, you can see the gradual climb, and this was during like a down, when interest rates were extremely low. And what we've seen now, when we shift over to the right side, is these are the three peaks for the amount of transactions that we've seen, and this has all been during a time of interest rates coming down, but interest rates are still extremely high. And this is why we're still getting this. And the Bank of Canada basically, like you said, came out and said, hey, listen, like, I don't know, like, there's not much we can do right now unless something basically breaks, which I think is what's ultimately going to happen. Because when you look back in history, every time that the Bank of Canada deviates to the downside from the bond market, they typically accelerate down even significantly further. We saw it in 2001 after the dot-com bubble. We saw it in 2008. And now we've seen a deviation again happen where they see the risks. The bond market is staying elevated a bit because it is worried about inflation to a degree. But clearly there's something that's worrying the Bank of Canada. And it's clearly the amount of debt that's in the system. It's the trade wars that are happening. It's the amount of investment that's left this country. There are some cracks in there that need to be, that we all need to keep an eye on, because the last two times that this happened, interest rates ended up going basically, well, at least in 2008, basically went down to zero.
Yeah, and so I think one of the big takeaways and why we're showing you guys this is that we just want you to prepare that this thing isn't going to turn around quickly. We've had multiple times throughout the last couple of years where we've spoken to agents individually, even with ourselves, with certain positive outlooks, where it's like, hey, maybe by next spring this thing's going to turn around. The spring market will be good, and then the spring market ends up being a dud, right? And the reason for that are these elements that you're talking about. We're talking about trade wars. We're talking about tariffs. We're talking about big debt ratios. And all of that is playing an impact on our housing market. And really, I think, Matt, one of the biggest things it's playing with is people's confidence in the housing market. Nobody wants to buy a house today, even though it's at a discount, if they feel like it's going to be worth less tomorrow. And that's one of the challenges that we're seeing. And I think there are buyers out there that have definitely taken advantage and made fantastic purchases. But I think it's that mentality. People are so worried about buying a dip. If it meant it was going to dip a little bit further, they'd almost rather buy up here knowing that it's on its way back up than make the smooth buy down here. And that's just something we've seen throughout all of these different markets as we've seen it start to rebound, is people wait and wait and wait, and then they end up buying, maybe back up here or something like that.
I think one of the other big factors too, other than just interest rates, is the jobs market is shaky right now. And when people go home every night and they listen to the news, and it's Stellantis is left, and this car company is let go of people, and Glencore is not investing in copper anymore, so there's another 1,000 people gone, and you start to see every day job cuts, job cuts, job cuts. It's hard to be confident to go out and to make any big purchases when the news in this country has been extremely negative basically this entire year. There hasn't been very many positives. We're going to get the budget in about 2 hours, which appears that they're going to try and really stimulate this economy. We'll see if all the parties back it and agree to it. But even then, that money will take time to get through the system. There'll be bureaucratic red tape that needs to get through. I don't think it'll be in time for the spring market of next year. But if $100 billion budget gets passed to supercharge this economy and get things rolling, then definitely once you start to see the unemployment rate roll over to the downside, then you'll definitely start to get more confidence come back into the market.
Yeah, so seeing that, it would be a good leading indicator for us to start to see things come back around in terms of then hopefully positive news is coming, some confidence is coming back. I think the other indicator that we talked about on one of our other charts was we're likely going to see sales start progressing first before we start, of course, then seeing the prices come up, which just makes sense. More and more buyers coming back in starts to alleviate some of that pressure and negotiating power that they have, because we're now removing inventory from the market. There's a few less homes for people to be going after.
Yeah, what we want to see, is okay. Let's say the beginning of the spring market, you start to see peaks greater than 2025 spring market. Then then that's telling us that the transaction volume is front running the prices. But it takes 3 to 6 months for that to kind of show up when it comes into the prices. So then maybe we'll finally see a floor to where prices are going to at least maintain.
Yeah. And so here you've outlined when the cuts were kind of happening. Is that right? Is that what our red bars are
Yeah.
saying? Perfect. So you can see in these markets, as the cuts happened, they really did stimulate the purchasing power that people were seeing, right? And that translated into run ups in median sale price, right? Now here, we were coming off the highest and quickest increases in terms of interest rates. So we're actually going through quite the opposite effect than what we saw in the last two times we were in a cutting cycle.
Yeah, and ultimately, just because of the just how high interest rates actually got cut, before these other two rate cycles were or cuts were coming off very low um, increases in the interest rate. So even in 2020, you can see that we were actually cutting rates before the pandemic. They had increased rates. I believe it was in, I can't remember if it was in the late 2016 and it went into 2018, and then the stock markets, housing market, everything started to roll over a little bit there. So they started to cut rates again. And then the pandemic happened, and that just supercharged things to the upside. And one of the reasons it supercharged things to the upside was because of the amount of money the government pumped into the economy as well. That's why we got such an acceleration to the upside was they bailed businesses out, they bailed people out. The central banks took as much uh, bad debt on their books as possible to make sure that it was spurring the economy. So now, we've brought rates extremely high. We've dropped them, but they're still as high as they were. Let's face it, back in 2010. And we're at prices that are significantly more elevated than then. Yet, and yes, wages have gone up significantly, but we're still extremely elevated. And this is what worries me the most here is, how sustainable are these elevated rates in Canada? The U.S. isn't backing off their rates anywhere close to what Canada is doing, and that's primarily because of how strong their economy is. Our economy is significantly in debt and has a lot of things going against it, and it's got me a little bit cautious about these next 6 months and how important it is, especially for this government to get some good investments for this country because we desperately need it.
Yeah, and getting the negotiations behind us as well for
Yeah.
the tariffs and trade. The other big thing that I want people to take away from this chart, and I think a lot of people have known it for a while now, is that interest rates alone are not moving the needle. This has been our past experience. A lot of realtors, this was kind of our past experience. This is where we're at this time around, right? So it's great that they're coming down, but we have too many other factors that are impacting the housing market right now. And so it's important for you to know, especially when you're sitting down and talking with your clients, that we don't, if people need to sell, holding on right now and holding on at higher prices or waiting for a rate cut isn't necessarily the move. There's a strong chance that right now they should have priced it right 8 months ago instead of being on the market all year, because now we're at a lower spot, right? And there's a chance that this continues for a little bit. We don't know how long, but if you're dealing with somebody in the short term that needs to make a move, don't wait on any interest rate announcements. It's time to get back to just pricing a home very well with what's happening in the market. Don't try to speculate on if this market's going to turn around. Choose the market of today when you're looking at your pricing, and
Yeah.
be sharp, because again, if you missed out in this window, it's unfortunate. It would have maybe pained them a little bit to make that sale at this time. But if they still have to sell and they have to make it at this time, it was almost a disservice to not get that pricing right the first time.
This is the big that's the biggest takeaway from what we're going to talk about today is anyone that's working with sellers, um, to price your property right. There's an insane amount of competition out there. Don't drag this into next year because the data is shaky right now, and it's not confident data, and that needs to be spoken to with the client to basically say, listen, it's imperative you get your price, where the market is right now, and try not to keep cutting, because you're just going to be catching a falling knife potentially going into the new year if Canada doesn't get the trade deal, doesn't get the stimulus that it's hoping for into the economy.
Yeah. And the other note I want to make is that the reason why Matt and I are bringing this up is not to be doom and gloom. You could be having your best year ever in real estate. There's a lot of agents that are. It's about the work that you put into it. But we also get the honor, privilege, and responsibility ultimately of showing up and helping people with one of their largest investments. And so the more information you have, and then paired with the more information that you can get from your client and what their goals are and what their situation is, the better you'll be able to show up and serve them. That's why we want to make sure we've got not rosy colored glasses as we look at some of the data, but very factual. Look at what the data is showing us so that we can help people make very informed decisions. All right. Now talk to me a little bit about, well, actually, we already went into this. I thought we'd covered it, but it was a slide that was indeed coming up. Talking about when affordability improves, the transaction volume will likely lead to prices going up by that next, or will lead it by that 3 to 6 months, right? We've got to see buyers coming back into the market, purchasing homes, alleviating some of that inventory level that we have before we see prices start to follow. And so, Matt, is there anything in particular that you wanted? Because we have talked about it a little bit, but in terms of these, talk to me about how you outline these ones here.
Well, I think one of the positives is that we keep bouncing off the trend line, which is good. We're not breaking below that. When we get closer to the end of the year, it's holding pretty steady there. And one thing I would say about 2025 is that typically we peak and then roll over on transaction volume, but this year we peaked and then kind of went sideways.
Yeah.
So it's a little bit deceiving, just because most years it goes like this. So in 2024 we did have a double peak, but in 2025 we basically kind of just went a little to the downside, but held up quite well, which is a positive sign for sure. But still generally lower than last year's sales, lower than 2023 sales. So I think what would be positive is to come down at the end of the year and test the trend line again. If not, stay above the trend line, which would be even better. So at least we're getting an idea of maybe a bottom's starting to form here.
Yeah, I think that's an important piece to note is how we've just kind of carried over, like it's rolled, but not in the way that we typically see. And I think this is a lot of what we talked about in the spring, Matt, is that all of those people that would have typically purchased homes in the spring, they didn't. We saw our spring sales volume just be, frankly, quite abysmal. You know, the lowest we've seen in 15 years. That stat kind of continues to get worse as we go along. But as this is held, I think that's all those people that just diverted their purchase to later on. Like we've said many times, life doesn't care what's going on with interest rates, what's going on with house prices. There will be people that need to move regardless because of their life situation. And so I think that we're just seeing that kind of carrying over as we see that push later into the year and not necessarily roll off, but just maintain a lower number than what we're used to seeing. It's important to note as well, this is coming off of really just since the rates went up at our 2022. For this chart, we didn't include all the way back. We have that in other data, but it's important to note where we are sitting there. All right, Matt, here's a big one. Talk to me about months of inventory, because this has got to be one of the most telling ways that you can evaluate what's going on in any market. To talk about what's going on with pricing, to talk about where buyers are, to talk about how many new listings are coming in. But ultimately, there's a very clear trend that we've been accelerating on since 2022.
Yeah. I mean, when you go back and we look at these blue lines, we can see where each year peaked for their months of inventory, which was typically in the earlier part. 2023 was on the later part. Actually, the last two were on the later part of the year where they peaked. But typically we peak and then we roll over. We get to a bit of a low, and then we start to make the upside again, maybe for one last push at the end of the year, like we did in 2024. But what's happened in 2025 is we peaked in months of inventory in May. We had two little slight rollovers, but we've remained extremely high the entire year. It didn't pull back during the summer months like we've seen before. It's remained extremely strong into the end of the year. So it'll again. This is kind of why there's a little bit of a warning in our message this week is because of how high this has stayed. It has not rolled over. It should roll over come December, January, but by how much, uh, we'll see. Uh, we're worried that, well, at least I'm worried that if it doesn't roll over a lot coming into next year, this number is going to be in the sevens potentially for months of inventory because we're just not getting enough sales or people taking their property off the market and saying, you know what, I'll wait. This is telling me they can't wait any longer. They need to sell potentially their property. And this is why you're having an extended stretch of months of inventory from May to October, and the potential of why you may see seven months of inventory uh, come early next year.
Yeah, and to follow it up with, as we've talked about, rate cuts. So in March of 2022 is when the rates start accelerating, start being increased, and then in 2024 June we start to get our first cuts, right? But we've just continued to extend our inventory levels beyond that, right? We're not. They haven't had time to really, I think, set in long enough, and there's still people that have been waiting for that other cut. Now, the one we got in October is great, fantastic. I don't know if I don't think that'll mean we get the one in December that we were looking like we were going to get. That'll likely get pushed into 2026. But at the end of the day, this is the trend line we've been on, even with those cuts coming. So we really need to see this. We need to see buyers start entering into the market, see this start to roll down, buyers scooping up some of that inventory. And like you said, Matt, perhaps we start to get some that now maybe decide they don't need to sell their house. But the concern you're talking about is there's enough people that do genuinely need to sell their house and they haven't taken it off the market, or the buyers haven't come in to get our lows, and we've just kind of been maintaining these levels with lots of stuff available to purchase, which gives buyers lots of choice and negotiating power on the downside. Okay, new listing volume. It's interesting, Matt. We've looked at this, especially as we break it down by municipality. A lot of times throughout the year, new listings have been bang on where they've been in the last 15 years. It hasn't been that much more dramatic when you look at the months of inventory. It's really just been the amount of sales are not being pulled out of the market, right? Like
Yeah,
this
and
isn't that high. It's high. Don't get me wrong, but um, a lot of this stuff is still kind of right in the middle where we would have expected it with other previous years.
yeah, I think the reason I made this chart with the blue line was to show that you typically have a new listing surge at the beginning of the year and then in the spring market. And typically you'll have the new listings at the beginning of the year break close to the high 3,000s to the 4,000s on average. You will get your spikes above the blue line, and in definitely the hotter years like we saw in 2017 and 2021. But what's only happened two other times here is that you saw the spring peak into the blue as well for new listings. And the other two times that happened was in the end of 2017 and 2018, which again were the result of interest rate hikes, were in the result of some of the new policies that came out with the government. But it is interesting to see that you had two rushes in the new listings, both in the spring and the fall, into that 3.5 4,000 new listing range.
Yeah. And again, looking back here, not not quite making it into our blue line, which is interesting enough as well. Is that a 2024 number that I'm looking at here?
For, sorry, which one?
This one right here.
Yeah, that's
20,
2024.
yeah, interesting that it didn't hit that same
Yeah.
kind of capita that we'd seen before.
But was also the first time, I believe a first time, or maybe the second time, the other time was 2021, that you actually saw the fall outpace the spring new
Springtime.
listings market.
Yeah. I mean, and 2021 would almost make sense for that because that acceleration through the end of 2021 to the start of 2022 was something that we hadn't really been seeing before.
Actually, it was the 2020 market because of COVID. We didn't see that that uptick in the beginning of 2020 because of COVID. We saw the massive spike in the fall of new listings once everything kind of got somewhat back to normal.
Right, right. All right, I'm gonna task this one to you. I got to get my laptop plugged in here. Funny enough, why don't you start talking to us a little bit about York and what we saw in last month? And I'm gonna say it right out. I did not expect to see that little bit of a boost that we saw in median price based on some of the other stuff that we were looking at. So it's nice to see that in the freehold market for York.
Yeah, we saw a 2.8% increase month over month. Now we're still down 5.5% year over year for freehold listings. Um, and I think, if we look at the dollar volume at the bottom, we saw 4.5% into the real estate market. So that's a great sign there. But when you look year over year, we're down 18.4% at the bottom there on how much money went into the real estate market compared to last year. Transaction volume saw an uptick month over month at 1.3%, but that's dwarfed by the negative 12.3% in transaction volumes that we saw year over year. New listings again was down 17%. Month over month, but up 6.8% year over year. And then the median days on market remained flat month over month at 23 days, but was up, or sorry, yeah, was up 9.5%. So basically two additional days on market from last year. And then the termination volume was down 5.4%, but year over year up 12.8%.
Yeah. Oh, let me come back here to new listings. And this is what we were talking about, right in the range of what you would normally expect. So this chart is dating back to 2011 and it's showing our monthly kind of rates for what we expect to see in new listings. And we're one of the higher months, but kind of right where you would expect to see it for the month of October in terms of new listings coming out. Now, here's the big one, like you showed with your other chart there, Matt. Our active listings, really, if you follow all of 2025, it has been the highest on record going back those 15 years or so, right?
Yeah. Yeah, and this is the thing we've got to. The only way that you're gonna get these off the market is through sale, because ultimately, sure, people could take them off the market and sit on them, but I think if you're selling in a market like now, you need to kind of sell.
Yeah.
So the only way that this really comes down is that buyers come screaming back into the market.
Yeah. And they that's the thing is they haven't sold through here. So if they were going to take it off, a lot of people could have taken it off previously. We would have seen that dip really adjust and make a meaningful impact on active listings, but people deciding not to sell because of the market hasn't really made a meaningful impact. We haven't seen it at all yet so far this year. So like Matt's saying, it really is the buyers needing to come back. And the concern that you mentioned, excuse me, Matt, in our previous slides was, is this going to carry through into 2026? What kind of meaningful drop may we see of people taking it off the market coming into December? And what does that really mean for us starting again in January? There's been a few of these down years, Matt, now in a row where we've talked about like, okay, the fall market didn't quite hit. Let's get it back out there at the beginning of the year. Hopefully more people haven't put it back on. The weather's cold. And usually that January, February is not a bad time. Inventory is typically lower. You'll have less competition out there. Well, 2025 blew that out of the water and we had 50% more active listings than the same time period the year before. What is that number going to look like for us this year? Now, maybe the percentage won't be as high because 2025 was a record-breaking year in terms of active listings at the start of the year, but I don't know. I think like you brought up, this is one of the concerns, as we are sitting down and consulting with sellers is that pulling it off the market and putting it back on in the beginning of 2026 still a viable move, or are we going to see what happened again in 2025?
Yeah, I think this number ultimately rolls over to the downside like it always does in November
Yep.
and December because people don't want their properties on the market for November and December. Um, but how high does that number stay going
That's the
into
question.
November, December, right? And then number two, what's the catalyst? What's the catalyst in the market to absorb that? And the Bank of Canada just came out and basically said, well, we've cut rates because we're actually panicking, but also we can't cut any more rates. This is up to policy now.
Hmm.
Like, this is up to government policy. So, like, if the Bank of Canada cuts rates again, something broke because that's what they told you. That's literally what they came out and said. Not much more we can do. That's about all we can do, like, in this current economic environment. So, I'd be worried if the Bank of Canada starts slashing rates again, especially if they go 50 basis points, because that's telling me something bad's happened. Job markets hasn't rolled over; it's still accelerating to
Okay.
the upside. So, like, it's just hard. It's hard to see how the spring market can be better than 2025 spring market.
Yeah. Now, I totally understand what you're saying. Historically, though, even if we make that another quarter point cut or 50 basis point cut, it's still not the lowest we've ever been or lowest that we've seen a couple of times,
Not even
right? So
close. We've
is
been living off cheap debt since
yeah.
2009, and then all of a sudden they're like, "Yeah, you got to pay 3x that now."
So is your main concern the amount of debt in the system to
Yeah,
be at that low of a
there's
rate
this.
again?
Yeah, people. You basically had extremely low borrowing rates since 2009, since the Great Financial Crisis. They've stimulated uh, an insane amount of debt. Even when you look at the amount of leverage in the stock market, even the U.S. stock market alone is over $1 trillion in leverage betting on the stock market. Um, there's so much debt in the system, and the Bank of Canada just came out and said, like, that we're done. That's it. We're done. Okay, so all that debt that was piled into over the last how many years, those people have basically been told, it doesn't get any better for you. So either you can afford it or you need to liquidate it. And that's what's going to be, we need to keep an eye on over the next couple months is, do they liquidate it? And I'm looking at active listings right now and they're not getting any better. And what's going to happen into January? This is really key. Is November, December, January, like, what you're going to see there. And I think what you're going to see there is there's people that need to get out because they need rates to come back to where they were before because they spent far too much money buying toys and properties and cars and in investments with borrowed money, and those rates the bank is saying are not going to get better for you. And if they do get better for you, it's because something broke in the economy and maybe you don't have a job to pay for those lower interest rates to begin with. This is one of the most important times to keep your eye on things right now, because we've seen these things happen in the past. I've said it in our conversations before as well, just because, like, things break when interest rates start to go down. You don't lower interest rates because everything's rosy. You lower
Mm.
interest rates because there's problems. There's problems, and they're trying to get ahead of it, but they're usually pretty terrible at getting ahead of it.
Yeah. Now I'm going to play devil's advocate on one point there about the the potential height of these active listings that we see and people needing to sell. I think there is an argument that you could make here, and even just through conversations with other sellers, is that one of the reasons why you're not seeing these people take it off the market isn't necessarily because they need to sell. They want to sell, but they're not moving it because they haven't come to terms with the new reality and price, right? We still got sellers that are not willing to come down to today's pricing value to actually move the product. But I don't know how many of them absolutely need to sell. Like, I don't know what percentage of the active listings is truly that, because we continue to see our active listings stay really high when our new listing inventory is right in the middle of where it should be. You know what I mean?
Yeah.
I'm not saying wrong one way or the other. I agree. I agree with you 100%. I'm just saying I think there is, if we are looking at indicators going into, December, January, February, and March, I think the big thing that I want to look for, like, is what you talked about at the beginning of our video, is talking about, okay, what is the government doing policy wise? Can we get some trade negotiations out of the way? Can we get some investment taken care of? Can we talk about what that budget's going to be later today? And is everybody on board with where the investment money is going? I think if we get those positive signs, I'm okay with active listings remaining high for a little bit, and I think that you might actually see that, because you might see sellers stay even stickier with their pricing, while buyers are like, I'll wait till, like what we talked about, I'll wait to see some other people jump into the pool, and then I'll come as it swings upwards.
It's possible, but when you think about, okay, what's driven Canada's economy over the last 10 years, it's been, or even if you want to say, what's driven the economy since 2017 to now, is you had immigration, which was increasing every year. So the amount of people that you're bringing into the country that were participating in the country, spending money, um, your housing market was driving the economy as well. So you got immigration, you got housing, and then another thing, you had governments hiring everybody, right? So you can hire someone into the government and then pay them with borrowed or like printed money, and that goes into the economy and drives up what the economy is. And what are we facing right now? Immigration that's falling right now, housing that's
On
falling
purpose,
right
right?
now
On purpose.
on purpose,
They're
and then
correcting. Yeah.
from what I'm hearing for what's going to come out in the budget today is that the government's going to lay off 70,000 people.
Yeah.
So that's 70,000 people that were being paid by printed money into the economy to help stimulate it. So, like I'm looking at the catalyst here for what could potentially get better. And three of the biggest drivers that were, okay, and also investors were buying all these properties, and now rents have peaked and they're starting to fall off. And you're starting to see a lot of purpose built rentals start to flood into the market now. So even mom and pop investors who bought rental properties, their rental rates are starting to come down while we're at record high interest rates. So like those four things right there that typically have been driving this economy for the last close to 10 years are all facing the other direction. And that's what's worrying me the most right now is that that's just the mentality of where this country decided it was going to head. Was that these were the biggest drivers of our economy. We were getting off the natural resources. We were getting off the things that made this country what it was. And we decided that we were just going to hire everybody. We're going to bring the entire world over here. We're going to stimulate our economy just purely on housing and hiring people. And that's not the case anymore. And that's rolling over now.
I
And
I think we can both agree on, um, based on our previous conversations, that while these things are part of the pain process now, I think they are part of the solution, right? Like,
yeah,
part of our problem was we did have too much immigration at once. So pulling back on that, we have felt the impact in the housing market, particularly I think the condo market in Toronto, which then affects everything else, because that's your stepping stone for people to get into housing, right? So I think that them I I understand that they're probably going to be reversing some of that, right? They're going to open the doors back up again, hopefully slowly at a pace that makes sense. And to the idea of the 70,000 government employees or that may be losing their jobs, we were coming off of, like you said, record years of the government hiring, which also bumped up some of those numbers, because then they paid them and all that. It goes back in the economy, makes sense. So I think what's happening is these corrections, it is causing pain, but hopefully it's pain for the right reason, right? I think
oh, it
that's
will be
something you're
absolutely.
aligned with, right? In
Yes.
terms of how that goes. So it'll be interesting to see how, I guess the recovery period is what's going to be most interesting to see. And
Which will happen, and it always does, and it
yeah,
always will. And I honestly believe that Mark Carney um, is moving towards the right direction of saying, okay, you know what? The world needs our resources. They can either buy them from Russia, they can buy them for these other countries, or we can sell them, right? And this country can make some of the profits from that to help better stimulate our economy in different and other ways. I think that's a 2027 story. I think
Yeah.
2026 is the issue. There's a lot of things going against us. Hopefully this budget comes out and we pump a ton of money into the economy next year by building great things again, which will ultimately put a flood of money back into the system and will start to move us in the right direction again as the world starts to buy our things, buy our gas, our oil, our timber, our minerals, something that we got away from for so long and decided, I don't even know what we were really selling to the
I'm
world.
I'm gonna cut you off right there because I wanna end on that positive note that you just mentioned. All
Yeah.
those investments that we're talking about, and for those of you that just joined us, this is our chart about active listings in the region of York for freehold homes. Matt, I think that was one of our better in-depth conversations in terms of the tangents of what is impacting these numbers. And as I look at the clock, I just want to make sure we get through to the rest of them.
Yeah.
But what the big takeaway that specifically coming back to York Freehold, the question that Matt and I are wondering about is we know we're going to see a seasonality dip here in our active listings. The question is, what does it look like at the start of the year? And Matt, I think we actually sounded the alarm bells for what 2025 was looking like right away in January last year when we said, hey, guys, we're starting 2025 with 50% more listings than we had the previous year.
Yeah.
All of that active inventory is going to have pressure on pricing. It always does. So where do we go from here? Now, we'd had some positive outlook from Treb and other institutions that we were going to start to see sales volume really start to head back up for the end of the year. And then the tariff talk happened and it all, slowed down and is way off course from where those predictions were. But this was the sign back then. And the question will be, what does it look like 2 months from now? All right. Sales volume. Matt, this is it. The buyers haven't been here, right?
Just flatlined.
It's flatline. We see new listings kind of in the flow with where they should have been on that previous slide. But the reason why active listings is so high up here is because we are not removing enough units from the market as our sales have been flat. We didn't see any spring market uptick. It just kind of did this on a steady increase to May. And then we've just been hovering around the same amount. It's almost to say, Matt, that in York Region freeholds, this 700 to 800 units a month is just life. That's people just buying and selling and moving because life happens. They need to upsize. They need more space. They need to downsize. They need less space. They move for a job, whatever it might be. And that's what it is. This is a needs-based market right here. That's the need that's been fulfilled. And when we talk about median price, we had fallen below 2021 back in July. What are we catching up to here? We're catching up to
2022.
Yeah.
2022.
So by fall of 2022, this is where we were at. So that's not terrible. I mean, it's not where we had anticipated with how we started the year, but or I guess not anticipated, but what we had hoped when we started the year. And here's where we are. For those that are wondering, like, is there going to be a further correction? I think there's still, like you were talking about some of those headwinds, Matt. There's still indicators of why this could continue to drop off. I'm optimistic that we're not going to bump down to the 2020 line. We still have a ways to go to get to that. That would be drastic. That would be something breaking. But Matt, if something does break and they really drop those interest rates, would that then be the point that money is basically free and people can come back into it? I don't know. That's more your lane than mine. But I think just enough to say that
the biggest thing would be as long as the job losses don't pile up.
Right.
The reason we saw the acceleration during COVID was because, yes, there was this massive spike in job losses, but then they realized, wait a second, everyone's going to keep their jobs because the governments are going to bail everybody out. I don't think we're going to see that happen in a market where there's not a worldwide issue.
Black swan.
So that's what you get cheap interest rates. As long as people have jobs, then you could see an acceleration. But if jobs start to tick higher, then you're not going to see. We saw that in the 90s. We saw interest rates get driven down in the 90s, but people were worried about their jobs during that time. So it didn't spark enough of a movement in the market. It ultimately will. It'll just take time.
Yeah. And that was the longest recovery period that we saw, right? That was because we've been through a couple of these now, a few of them, but really it was the 90s where we saw the slowest recovery and the biggest drop. So this feeling more like that, I think it is prudent to be prepared that these low sales figures and lower prices could continue for some time.
Absolutely.
And here we go. I mean, at least it dropped off a little bit there. We're now currently sitting at 6.5 months worth of inventory. We did see an uptick again, but overall not continuing quite as high when we look all the way across York in terms of seasonality now, right?
Yeah.
All right. Taking a look at the condo market for York region, looking at our median price, down 6% month over month, not what you want to see, but again, hovering around numbers that we've been seeing all throughout the year. That median price of the low 600s, I'd say, Matt, has been pretty steady. Transaction volume dropping month over month by 20%. That's a little bit harder to swallow in the month of October, coming off of September, down about 25% year over year. Prices down 9.6% year over year. Looking at our new listing volume, pulled back just a little bit, hopefully helping our supply issues that we've been seeing in the condo market. Median days on market taking a good jump up there in November, moving from 27 days to 34 on average is a larger jump that we usually don't see in a month over month basis for days on market. And termination volume actually coming down a little bit. So that's as well interesting to see. Up only 5% year over year. So that's not bad either. Like not terrible numbers there. Coming into new listings, the condo market has, unlike the freehold market, has remained higher in terms of new listing stuff. Whereas in the freehold, we've been seeing more kind of middle of the pack. New listings for the condo market on the higher end.
The condo, when you go back to the new listings volume, you can see like it got a little bit scary there when you look back in May, just how deviated it got from the prior year. But it's caught back up to where it was 2024 for the end of the year for the new listings volume.
Yeah, really coming off of July into August, we started to see back to, the highs of recent years. Not the norms that we've seen, but at least the highs of recent years, and not setting really out there new records.
Which has saved itself a little bit for the active listings, which still sits extremely high. But
we just saw that little adjustment through August and then kind of maintaining, right? Taking a look at our median price, again, kind of like hanging around. It has dropped a little bit lower. So I thought we were up a little bit higher. Now down being at 6. That is the lowest we've seen for the condo market through 2025.
I don't see how this doesn't pass 2020.
I agree. I think our condo market's in for a tougher haul, and it's going to take a longer recovery. So this one trending towards 2020, there is a good chance that the condo market does come down to there. And so currently that'd be a 568. Even so 2020, we move into 2021, a decent jump there from there year over year to an extent. So it'll be interesting to see how we pan out in January. But yeah, good chance hopefully we just come close and we give it a little bump and then move back on. But condo market's been a little bit of a different story. And this is one of those reasons 7.6 months worth of inventory is quite high in terms of available listings that buyers have choice from and have choice to negotiate at. All right, Matt, take me away with what's going on in the Newmarket Freeholds.
Yeah, we had a little bump up in price, 2.4% month over month, but still down 7% from last year. Transaction volume was down 4.5% month over month, and it was down 8.7% year over year. So really what we're seeing across most places, which is about the same. New listings month over month down 10%, but up 21.6% year over year, which is a big increase. Median days on market fell 11.6% month over month, but year over year up 11.8%. And termination volume was up 12.2% month over month and 33.9%. So still seeing that price need to be adjusted to get it dialed in. But when we look at the total total dollar volume, even though we were up 2.4%, we were actually down 2.4% in the median price. We were down 5.2% in total money in month over month.
Yeah. And an important thing to note, because you can see some big swings in these numbers. Like, again, if you look at the average list price, because now we're taking a look, okay, Matt's talking about termination volume happening because people are canceling and relisting. We're trying to get sellers to the right price to get our sales volume to increase, right, to help them sell their home. And when you look at the median list price, it's interesting. The average was such an extreme there for Newmarket. This is something you'd typically see more so in Aurora than you would see in Newmarket, but our median price still holding true. Not too much of a deviation there.
Again, that's why I like median. Like
Yeah,
average can get skewed too much.
yeah,
I don't know if that's a typo in there. Uh,
yeah.
that it's, what, 600 and something $1,000 differential month over month for average list
Mhm.
price.
Yeah, it's like it stood out to me. That's why I wanted to bring it back. But all of this stuff is pulled from Habistat, so it's interesting to see that that number would be there. That indicates to me there's some really big homes that must have got listed last month and that just aren't here this month,
Mm.
because otherwise, or that dreaded zero that a listing agent puts in and lists a home for 50 million when it was supposed to be 5 million, for example,
That's probably it.
right? That's the only thing that makes sense for such a
Yeah.
huge disparity. And again, going off of our current month, you can see that we're down 6.9% in terms of year over year. And so again, if we're looking at the sales price, even looking at the median price, we're down 7%. So for the stuff that's selling, it's, we're getting close, Matt. We're getting close. Like if the median list price is off 6.5% compared to last year, we're only 0.5% off from what's selling. So there is hope that sellers in Newmarket are coming down to where current buyers' expectations are in terms of value. New listing volume, again, kind of in the middle where we would expect to see it. Just right there, bang on. And our active listings, Matt, not as high as we've seen in some other areas, but still one of the top three highest in terms of
Yeah.
active listings, right? Really just 2017, 2018
Yeah.
surpassing our active listings. Oh, I want to come back to sales volume. Again, no real big peaks that we typically see in the spring around April or May. Just kind of riding the wave a little bit, optimistic going into May, and then just cruising, tailing off more so than anything coming through to October. And median sale price, again, look at where we started this year at, and where we are now. And again, this is an indicator, Matt, really getting closer to that 2020 line, more than anything, more than some of the others that we've seen. It'll be interesting to see how that.
And you know what? This chart tells me that Newmarket has, accelerated to the downside a lot more than the York region average, right? So
Mhm.
a lot of the price has already been sucked out of Newmarket. So even though, we've got some headwinds coming up, Newmarket is a place that's already kind of seen some of um, that price taken out of the market. So
Mhm.
do I expect it to like significantly fall? Like maybe not as much in the Newmarket area because we've seen that pullback so much so
has
far.
has already happened. Yeah,
Yeah.
great point. Months of inventory, we didn't really see as big of a drop like we saw in York, but I think part of that is just because we're not at the same highs. Like I think for York overall, we were looking around 6.5. We're down at 4.8 months worth of inventory. Still up there in terms of our highs, but hasn't really come down from that. That just seems to be its manageable spot, for the market currently.
Mhm.
All right, let's talk a little bit about what's going on in the Aurora Freehold market. Unlike what we saw in York as a whole and Newmarket, we actually saw a decline there in median price of 2.3%. So coming down from 1,195,000 to 1,166,000 in terms of our median sale price. That's now down 12.5% in comparison to the same time period last year. Transaction volume, we saw a couple more units. We saw 3 more units sell, up 5.9%, down 3.6% the same time last year. New listings down just a little bit month over month, but up year over year, or 23.7% there. Our median days on market, we actually saw a decline there. So moving from 21 days to 18 days for a home to sell. Termination volume hovering around the same. So 1.2%, not much fluctuation change there. And when I take a look at median price did see a drop of 8.5%. And this is, Matt, is something I've been seeing a lot in Aurora, is I have seen sellers canceling and relisting at lower prices, and some at prices that are a little startling, where it's like, oh, okay, that was a big cut. You are definitely in the camp of some of those people you talked about that need to sell. They are making a change. And I think that this adjustment of 8.5 in terms of our our median listing price, you start to see a big difference. And here, what's interesting, Matt, is in Newmarket, we were almost level. This one's still catching up a little bit to the sale price, but in fact, our median list price for Aurora is down 14.3% year over year, but the price is down only 12.5%. So we've actually cut more on the listing side. It's interesting.
And you know what? That's a good point you brought up with with some people drastically taking or slashing the price to sell their property, is that when you have those higher elevated listings on the market, the months of inventory, and you start to get those people that have to just dump for whatever they can get, that becomes the comparable in the neighborhood. And the longer that the months of inventory stay extremely elevated, you start to see that pressure on price, and it can get carried away a little bit, just because new comparables are being made, and now buyers are expecting those prices as well.
Matt, I'm so glad you brought that up. We've talked about this on a lot of other videos about you either want to make the market or follow the market. And what you just talked about is somebody that's been out there for a long time and they do have to sell. When they sell at that lower price to really entice a buyer to make an action now every other buyer is looking at that sale. And whether that was a seller in distress or not, buyers really hang on to what that price is as the comp. Well, I could have bought that one around the corner for 100K less. Okay, now in your seller's situation, your market has been affected. And I think an easy chart to look at, Matt, I'm going to skip ahead just for a second because I think that was such a good point, is as we talk about these active listings staying high, that is a great way to articulate that concern to a seller. Say, these people that have been out here trying to sell for so long, if there is a desperate person out there in your neighborhood and they sell down here, that becomes the new norm for the neighborhood, or at least the new hurdle that you have to try to get over in convincing a buyer or articulating your home's value. And that's the concern of listing high as opposed to listing at what current market value is. So you're more likely to get caught out in that situation if you list high as opposed to listing at value.
Yep. And I was doing an open house just a couple of weeks ago, and the neighbor had sold their property, and they were standing out front, and it was very slow at the open house, and the neighbor walked up and had said that their agent told them they had already bought another place, and he told them, which was what we would tell our clients, if you want to make sure that you're going to get that place and you're not going to have any problems, you've got to move off this property. And that's ultimately what they did. I was doing this open house for another agent, but that's going to have an effect on the price of their property now, because that neighbor sold at a discount to go to something else that they wanted.
Yeah. And that seller that makes the discount, it could still be very much a fruitful decision for them. It may not just be taking a loss, because if they're doing a move up right now and they've negotiated enough off what that price has come down, it could be a net gain for them at that point, right? So it's all relative on how it works out, but you need to be aware of that. What the neighbor does impact you in terms of the eyes of the market.
Especially with months of inventory as high as they are now.
Exactly. And that comes into our high in terms of active listings, highest we've seen since 2017, 2018. Coming into sales volume, again, we didn't see any of our big spring market. And quite frankly, we haven't seen our fall market either, right? We didn't see any of these bumps. By November, everything's starting to roll over. Typically, there's a couple of years where we saw it accelerate into November, but typically what we'll see is the rollover by then. And we just didn't see any high. This is just going to be a gradual wave as opposed to a peak in terms of our sales volume. And then median price, again, looking at where we started the year to where we are now, coming a little bit closer to that 2020 than we've been previously, sitting at 1,166,000, where our next real batch, because it's everything was 2021, 22 was all at highs. But even if you look at where 2023 and 2024 were, it's a tremendous adjustment there in our median price, Matt. When we're looking at Aurora,
It
it's
is.
interesting to see how tight those stayed in comparison. Whereas a lot we already saw deviations from that price, but Aurora, it almost contrary to what you saw in Newmarket, where Newmarket has taken their lumps. They've had the adjustment. They're now down to where they should be. Aurora, it feels like they held off, and now they're
Yeah.
taking their lumps in terms of where that
Yeah.
adjustment.
Yep. I totally agree.
Yeah. Months of inventory, we've had a couple of big peaks. We're dropping down now to 5 months. Not that far off of Newmarket at 4.88. So again, months of inventory is definitely very much a buyer's market, but it's it's not the highest we've seen. So I don't know. It'll be interesting to see again, Matt, what this looks like going into January. We are still riding peaks in comparison to previous years. Again, even leading up from 2011, we're nowhere near where we are currently.
Yeah.
All right, Matt, let's roll into Georgina. What's happening in the Georgina Freehold market?
Yeah, so median prices were down month over month 2.2%, year over year only down 1%. We've talked about Georgina before. Some of the other places that we're looking at, especially Newmarket, Aurora. Aurora was down 12.5% year over year. Newmarket was down 7% year over year. So in Georgina, we're down 1%. Why is that? Well, I think the further out you are from the GTA, you're going to get hit first, and then the prices are going to decrease the closer you get to Toronto in the distant future. So Georgina's kind of, when we were talking about Newmarket, how they've kind of come down to where maybe they should be, maybe a little bit more to go. But I think Georgina's definitely in the same boat. They already got hit pretty hard when it came to prices. So only a 1% down from year over year.
Yeah.
When we look at transaction volume, it did fall 8.5% month over month, but was up 8% year over year. So did Georgina potentially bottom out last year around this time? I guess we'll find out when we look at the next set of charts. New listings volume was down 13.2% month over month, but was up 6.5% year over year, which was a lot less than some of the other places that we've looked at. And then median days on market has crept up 18.8% month over month and 5.6% year over year. Termination volume was actually down 2% month over month, which was good to see, but still a bit elevated at 19.5% year over year. And interestingly, year over year for the total dollar amount invested was actually, or it tied up in the purchases was actually up 7.1%, whereas in Newmarket down 10.2, and in Newmarket 12.8, and Aurora 10.2.
And one of the areas that actually is showing that positive transaction volume on a year over year basis.
Yep.
Right? All right, new listing volume again high, but in the mix with previous years that we've seen. Rolling into our active listings, still record breaking. A couple of our other municipalities have dropped down to just below what 2018, 2019 would have been. Georgina, not so much at the moment. So it's interesting to see, because when you're here, you're seeing a couple healthier indicators than we've seen in other municipalities. But when we are looking at active listings, fairly high, and I think the difference I would have liked to see, to be honest, would have been more so in the sales volume. And it's interesting to see it carry pretty flat when we saw that it was up on a year over year basis, right?
Yep.
And it's negligible. Like here again, looking at 2024, we're looking at 50 units in comparison to 54, right? Median sale price, middle of the pack. This is one where again we haven't seen. It's funny because they did take their lumps earlier over here, but above some of it so far. Like they're above 2020, and they are what else are we above here? We're above 2023
Yep.
in terms of our median price. So, Georgina, one of the I want to say one of the healthier areas right now.
I think they did their pullback earlier.
Yeah.
And this is the only chart that we're going to look at where we're actually above another year other than
And 2020.
2020. And and to be fair, like, does Georgina's prices get as carried away? Well, I guess they did a little bit when you look at 2021, or sorry, 2022.
Yeah.
But it's fallen back to a very stable range that you're seeing for 2023, 2024, 2025. So I think like Georgina, like if you're a buyer going into Georgina, there's yes, active listings are elevated, sales are down, but the price is holding up
Yeah.
a lot better, which tells me that yeah, maybe places are sitting there a little bit longer, but at least people are still willing to pay a very comparable amount to the last 2 years.
I think a lot of that has to do with, again, these affordability price points, right? The
Yeah,
price point that we're talking about in today's economy is much more affordable for a lot of people, which is why it's been able to maintain in comparison to just honestly anything over the $1 million mark in general this year has had struggles, let alone when you get above 1.5. But I think that's a true testament to affordability in Canada right now, where this is an affordability mark for people's housing, where we can still see sales volume like that.
yeah,
Months of inventory. Again, Matt, it's up over even Newmarket and Aurora. We're looking at 6.33 months of inventory in comparison. Again, still trending upwards. So it's not that it's all rosy, but I think the difference is because sales have still been able to happen, even though they're flat in comparison to previous years. People are buying because of that affordability. It's removing enough inventory that stuff is still happening, right?
yeah.
All right, Matt, take it away for Simcoe. We're talking now freehold homes.
Yeah, so Simcoe, I thought that we might see at least a little bit better numbers on the median price year over year, but month over month it's down 0.6%, year over year down 5.7%. When transaction volume down 7% month over month, down 7% year over year.
Mm-hmm.
New listings down 18.5% month over month and up 12.6% year over year. Median days on market was flat month over month, but up 11.5% year over year. And then termination volume was down 8.5% month over month, but up 46.3% year over year. So definitely some pressure on clearly in the Simcoe market here, with prices being down 5.7%. And if you've been watching our videos for a long time, you've seen the price decreases happen in Simcoe for quite some time here, and it did look like they were starting to stabilize. But clearly by the data that we're seeing here today, there's still some more pain in the Simcoe market that needs to happen.
Yeah, and it's
And
interesting.
this might have something to do with the back to work.
Yeah,
Because you know what, Georgina is still somewhat viable, getting on the 404 to go downtown and whatnot. But Barrie, you're quite a bit farther up there potentially for some people.
mm-hmm.
And now that all these companies have mandated maybe at least 3 days back to work, 4 days back to work, that maybe we're starting to see that pressure happen in Barrie. Because I know I dealt with a lot of clients during the pandemic who moved to Barrie because they were going to work from home.
Mm-hmm. Yeah, good point. Interesting to see as well. We have seen with the termination being up 46.3% year over year, we are seeing some of that adjustment there in the average price, again, on a month over month basis, even though terminations were down in comparison to month over month. So it's interesting to see how that looks. Now, talk to me about the Simcoe condos. What are we seeing here?
Yes, on the condos, we actually. Oh, sorry. This is the rental report. It appears.
Oh, perfect. So we moved on. Actually, I want to call it quits there for today.
Yep.
Um, Thank you everybody so much for joining us. We hope that for you realtors that are watching us, we hope that you're coming away with a little bit more knowledge, a little bit more ammunition, and again, the ability to break down the data for your clients to help articulate the best strategy for them. At the very least, outlining all the information they need to make a great decision, but also a great way for you to show some of the pitfalls that can come with not having your pricing super sharp when you're on the seller side. Of course, there's great data in here to show buyers that there's a lot of opportunity out there in the market, and even how quickly that can turn around. Matt, I think that might be something that we should look at for a separate video on the side, is when we have come off of slow markets, how quickly does it take for the market to come back around? We've quoted in there 3 to 6 months as we start to see prices lag sales volume, but it'd be interesting to see what that looks like, especially if we end up in a situation where maybe something does break, like you said, and we do start to see much lower interest rates. Now, I know that's not really the outlook that we've been talking about up until now, so I look forward to talking about that with you more. But nonetheless, long rant. That's what I hope you guys take away from our videos. Matt, tell them a little bit about what we've got coming up in the next video we're doing later on this week.
Yeah, so for Thursday, we're really going to break down some of the economic indicators that I've been talking about during this video. We didn't get to show them today. We wanted to keep it more statistic on what's happening in our local markets. But Thursday, we're going to be talking about what the Canadian government in their budget came out with, and what the implications for the economy, for the housing market, for the jobs market, all that kind of stuff is potentially going to have. Maybe even how long it might take to get through the system. But also, we're going to look at some historical charts in terms of interest rates and what typically happens when certain indicators get triggered. And historically, was it a positive or a negative for the housing market? So we want to dive into that as well.
Beautiful. I love it. All right, everybody. Thank you so much for joining us. We will see you next time. Matt, thank you as always, brother. Have a great
Take
day.
care, guys.